Hi everyone, my name is Manvi Walia. Welcome back to my channel where we simplify finance for students and professionals. Today we are diving into the basic of financial statements, a must know for anyone starting their finance journey. By the end of this video, you will understand what financial statements are, why they are important, and their key components with easy to follow examples. Let's begin by understanding what financial statements actually are. Financial statements are formal record of a company financial activities. They provide a snapshot of the company financial health and performance over a period. Just take an example. Imagine you run a small bakery. Your financial statement will show how much money you earn from selling cakes, how much you spent on ingredients, and how much you have left in your bank account. Financial statement used by management for decision making purpose, investors to evaluate profitability, creditors to assess repayment ability, regulators for compliances. Now that we know what financial statements are, let's talk about why they are so important. Now we discuss it one by one. So just start with point number 1, decision making tool. Help stakeholders make informed decision. Point number 2, transparency. Build trust among investor and creditors. Point 3, compatibility. Enable comparison with industry peers. Just take an example. An investors comparing your bakery with another would use your financial statement to decide which company is performing better. Alright, let's now dive deeper into the types of financial statement. This is where things get exciting. Let's start with the first type, income statement, also known as profit and loss statement. Point number 1, purpose. The income statement helps us understand how profitable a company is over a specific period. Point number 2, key components. It has three major parts. Part number 1, revenue. This is the total amount of money the company earns. Part number 2, expenses. These are the cost the company incurs to earn that revenue. Part number 3, profit or loss. This is the result when we subtract expenses from revenue. If revenue is higher, it is a profit, otherwise, it is a loss. For example, imagine you own a bakery. This month you sold 1 lakh worth of cakes. That your revenue. To make this cake, you spend 60,000 on ingredients, rent, and staff salaries. These are your expenses. Now, if we subtract 60,000 from 1 lakh, we get 40,000. This 40,000 is your profit for this month. Now, let's talk about the balance sheet, which give you a snapshot of your business at a specific moment. So, now let's discuss with the point number 1, purpose. The balance sheet helps us understand the financial position of the company on a specific date. It shows what the business owns, what it owes, and the owner's contribution. Point number 2, key components. It has three main sections. The first one is asset. These are the things the company owns, such as cash, equipments, or inventory. Now, the second one is liabilities. These are the amounts the company owes to others, like loan or unpaid bill. The third one is equity. This is the owner contribution to the business plus any retained earning over time. Now we discuss the point number 3, formula. All these components are connected through this formula. Asset equals to liability plus equity. Now we understand with an example. Let's consider your bakery. At the end of the year, your bakery owns equipment worth 2 lakh. That's your asset. However, the bakery owes 50,000 in loan, which is your liability. If you contributed 1,50,000 to start the bakery, that's your equity. Notice how the balance assets 2 lakh equals to liability 50,000 plus equity 1,50,000. The next one is the cash flow statement, which track the movement of money in and out of your business. The first one is purpose. The cash flow statement help us understand how cash moves through the business. It shows where money comes from and where it being spent. Point number 2, type of activities. The cash flow statement is divided into three categories. First one, operating activities. These involve daily business operations like sales and expenses. Second one, investing activities. This cover buying or selling assets such as equipments. Third one, financing activities. This includes loan taken or owner's capital contributed to the business. Let's go back to your bakery example. You earn 1 lakh from cake sales. This is your cash inflow from operating activities. You then spend 80,000 on ingredients, rent and buying equipment. This is your cash outflow from both operating and investing activity. The difference is 1 lakh minus 80,000 give you a net cash flow of 20,000. Finally, let's touch on the statement of change in equity. Although it's optional for beginners, it is a good to know about it. So, the point number 1 is purpose. This statement helps track how the equity of the business changes over a specific period. It gives a detailed view of what has increased or decreased the owner's stake in the company. Point number 2, what it includes. The key items that affect equity are profit added. These are the earning invested into the business, and dividend paid. These are the portion of profit distributed to the owners or shareholders which reduce equity. Now, let's go back to your bakery example. This year your bakery earned a profit of 40,000. If you reinvest all of it into the business without taking any out, your equity increased by 40,000. However, if you decide to distribute 10,000 as a dividend to yourself, only 30,000 will be reinvested and your equity will increase by 30,000 instead. Now that we have covered all four type of financial statement, let's see how they are interconnected and how they work together to give a complete financial picture of a business. Point number 1, introduction to relationships. Each financial statement provide unique insights, but they are not standalone. They are deeply connected, and understanding these relationships help you analyze a business holistically. Point number 2, key relationships. Let's break down the connections. First one, net profit from the income statement added to equity in the balance sheet. So, the profit a business earns does not disappear, it's either reinvested or paid out as dividend. The retained profit increase the company equity on the balance sheet. Second one, cash flow statement explains changes in cash balance between two balance sheet dates. The cash flow statement shows how the cash position changes over time due to operations, investments and financing. This change in cash directly reflect on the balance sheet as the updated cash balance. Examples to illustrate relationship. First one, income statement and balance sheet. Imagine your bakery earned a 40,000 profit this year. This profit moves to the balance sheet under retained earnings, increasing the owner's equity. Second one, cash flow statement and balance sheet. Let's say your business cash increased by 20,000 this year. The cash flow statement explains how this happened, perhaps from sales, loans, or selling equipments. This increased cash balance is reflected on the balance sheet under cash and cash equivalents. Now, come to the conclusion. By connecting these financial statements, you can see how each part of business interact. The income statement show profitability, the balance sheet capture the financial position, and the cash flow statement explain how cash flow in and out to support these changes. Now that we know how the statement connect, let's discuss how they are practically used in real life. So let's take an example 1. An investor check the income statement to see if your bakery is profitable before investing. Example 2, a bank looks at the balance sheet to decide if you are eligible for a loan. Example 3. You review the cash flow statement to ensure you have enough cash to pay supplier next month. Before we wrap up, let me give you a few quick tips to make learning financial statement easier. Tip number 1. Start by analyzing a small business example like our bakery case. Tip number 2. Learn key financial ratios. Just take an example of profit margin, debt to equity. Tip number 3. Use templates or accounting software for practices. And with that, let's quickly summarize everything we have learned today. Today we covered the basics of financial statement, their purpose, types and importance with relatable example. If you found this helpful, don't forget to like, share and subscribe. Also drop your question or topics you will like me to cover next in the comment. Thank you for watching and I'll see you in the next video. Until then, keep learning and growing with Manvi Walia. Bye.